Hey folks, Dan Frio here with your market update for September 13th, 2024. Happy Friday to everybody out there. So today's topic we're going to talk is when the Fed rate cuts, when they cut the rates, what's going to happen to mortgage rates on that day, on that specific day. So that'll be our topic for today. But without further ado, let's get over these things because that's why you're here. So here's the top 6 products people use when they're buying their first house. Rates were just, I'll say they're steady. Okay, and up 0.03 or a 0.05. Let's just say that's flat for the day. Economic news for today, there was only 2 things. Well, there's a whole slew of stuff here, but the 2 things we're going to focus in on is export prices and import prices, and they both were down considerably. Last reading on the import prices or export prices was 0.5. It was supposed to go down to negative 0.1. It went to negative 0.7. Okay, and then our import prices went from positive 0.1 to a negative 0.3. So that's helping on the pricing side of the equation. Let's get over to here. This CNBC our bond market report right here. You can see bond market. The bond market is basically zero. So that means mortgage rates aren't going to change a tick. So now we want to focus in on, again, we want to focus in on now because a lot of people are calling me saying, Dan, I want to wait for the 18th when the Federal Reserve cuts rates because rates are going to go down that day. Well, that's not how it works. So the way it works is this, but I'll go over that in a second, but let's go over here. We have a guy from, I think it's Wells Fargo. He's being interviewed and he gives his take on the price cuts, what the economy's looking like and so forth. But when we come back, I'll explain to you on September 18th what exactly is going to happen. So without further ado, let's get to this explanation. And then when we come back, I'll put all this together for you. So take it away.
Next guest expects the Fed to ease rates in September and in November this year. Daryl Cronk is Chief Investment Officer for Wealth and Investment Management at the Wells Fargo Investment Institute. Daryl, it's good to have you. You're even going, you think they go in the election month?
Yeah, I think they will. I mean, and I think what you'll get is, if you include tomorrow's CPI report, you'll get 3 more CPI readings and 2 more PCE deflators, which the Fed cares more about PCE deflator, which the latest readings are at 2.6, a stone's throw away from their range of 2 to 2.5. So I think they'll get what they need to go ahead and make that first move in September. They also keep it away from the November election, right? So you don't have to worry about that being the argument. And then we still think they follow through November. And remember, the November Fed meeting is after the election. So
True.
It's not before.
But, I mean, all the speculation kind of happens going into that. Even now they're under pressure. You kind of got that vibe with some of the questions in front of Congress the past couple of days of those incumbents who had hoped that rate cuts could help them keep office.
Yeah, I think that's true. I think there's other, political winds blowing and brewing there that will be more important than interest rates and what's happening. But, what people forget about inflation, and I think is really important, is inflation is a price increase over a time period certain, month over month, quarter over quarter, year over year. So even if prices are only going up at 2 or 3 or 4%, they're still going up, right? So consumers that are stretched and having a difficult time paying 7 to 8% for mortgages or 15, 16% for auto loans or 22, 23% on their credit cards, right, are still feeling the pressure as they're living paycheck to paycheck. And we see that in the consumer data.
Let's talk about kind of tactically what you're doing. All of the debate and discussion has been around, do you kind of lean into the momentum trade with tech and AI or lean against it? And you seem to be moving to neutral on that area. It's not, you're not underweighting it, but you're kind of saying maybe lean back a little bit. Why?
Yeah, I mean, obviously, big win that we're 5,600 on the index. But what's important and what people aren't paying attention to today is if I look at all-time highs on the S&P at a market cap weighted index, the reality is if I go below the surface, the number of members of the S&P 500 that are above their 200-day moving average are at a new low for 2024. Right? So what does that suggest? It suggests breadth is very narrow here again. We've known that for some time, but it continues for that, right? So even though you've got the critical few powering on, the reality is they're still going to put up, those big tech names are going to put up great earnings growth this quarter, but we just find there's other value in places like industrials, materials. We think healthcare can be a good value and be a little bit defensive at reasonable valuations. And we love energy. Energy is our favorite GIC sector at this point.
I mean, the valuations there look super compelling, but, the stocks have a hard time sometimes breaking out to the upside. I thought it was interesting you talk about a little bit of a defensive tilt, even though you think the economy is going to reaccelerate in the fall. Is that right?
Yeah, I mean, look, we had 1.4% Q1 GDP growth. We're on pace to track right at 1.5 for Q2 when we finally put it in the books here. The second half to us, though, looks a little bit challenged. I think those higher rates and the sustained inflation grinds a little bit on the consumer and on spending. Housing looks like it's weakening a little bit. So I do think the second half weakens a little bit. Is it enough to throw the economy into recession? Probably not. But it's not going to turn around and reaccelerate, even if we get the 2 Fed cuts.
So you don't think it's going to turn around and reaccelerate even with the Fed cuts?
I don't think economic growth is going to turn around and reaccelerate. So I think you're going to still stay at this kind of downshifted trend to around 1.5% to 2% growth, which by all accounts meets this definition of soft landing, no landing. So we avoid the recession. That's a good news story. But again, that's priced into the baseline here, right? And so I think if things continue to slow and soften from here, and you maintain, some level of inflation, I think we're going to test the consumer and the labor market. Right, and those are the 2 linchpins that need to hold for the risk assets in the stock market to continue to go higher.
Perfect analogy. Okay, so that was his take on the market and what's going to go on. So now let's fast forward to what's going to happen on September 18th. So let's go over to right through here, the CME FedWatch tool. And there's a reason why I'm bringing this up. Okay, so right through here, this is what we call the CME FedWatch tool. If you're new to this, basically what it tells us, the CME, Chicago Mercantile Exchange, they put this together. They're giving us a prediction. So in 5 days and 3 hours, what's the Fed going to do when it comes to the federal funds rate? Okay, so it tells you right through there. So let me explain all this for you. Okay, over through here, this is where the federal funds rate would be, or the rates, interest rates, right along through the top here. Okay, here, hold on 1 second. So right through the top. All right, so now down through here, what we're seeing is, you can see right through here. Right through here is where you're going to see the rate. Okay, so for example, 375 to 400 is 3.75 to 4% interest rate. So if we scroll over to all the way to the right side, there's not a number there that should say 5.25 to 5.5. The reason being is that's where we are now. But the reason being is they're saying the Fed is cutting for sure. So there's a 51% chance that they're going to be at 500 to 525. So that means they're cutting 25 basis points. Now let's go move forward. Okay, so we pretty much know that this cut's in the bag. So now going forward, just on Wednesday, we had the November meeting, which is right through here. There was if you go over to the 450 to 475 range, that was like 60% on Wednesday. Now it's 92%. Why it jumped up so much was just the economic news this week. So they're expecting a 25 basis point cut at the next meeting, and then a 50 basis point cut at the following meeting. Okay, but let's forward fast all the way to January 1st of 2025. So you're going to see this cell right here. Where's the most probability at? 375 to 400. That means they're going to cut from where we are today, 150 basis points. That's a 1.5%. That's a lot of cuts from today to then. Do I feel that that's where we're going to be? Not really. Okay, so that's my take on the market for that. I think they're going to give us multiple 25 basis point cuts, and I'm predicting that we're going to have a soft landing. That's what I'm saying, because like the young man was saying, GDP's in line. We don't have massive layoffs. Yes, we don't have the hiring as enthusiasm as we had it, but we don't have massive layoffs. Yeah, we'll have bits and pieces there. So that's that equation. So now here's what's going to happen. All right, we're already being told there's a 50% chance they're going to cut rates. Okay, so let's think of it this way. Let's think on the 18th. Let's reference it as the stock market. So let's, for example, say on the 18th of then next week, that Apple Corporation is going to come out and tell us what their earnings are, and they're going to put it on paper and say, here's our earnings for the quarter. All right, and what's the stock going to do? Well, maybe nothing. And the reason being is this. Let's say, for example, a week or 2 or 3 before that, Apple's CEO came out and said, our earnings are going to be terrible. Our sales are flat. People are quitting. Everything is just terribly bad. Well, are people going to wait until the 18th when Apple comes out and actually gives us their earnings report? Or are they going to start selling the stock now because they just heard from Tim Cook that the financials are terrible? Now, this is a hypothetical, so don't go out there and sell Apple stock. But you get what I'm saying. So on the 18th, the Fed's going to come out and say, okay, here's what we did. Well, we probably already knew it right through here. So the traders are already doing this behind the scenes. That's why let's go back to the rate sheets that we see, and you're going to see it right through here. Let's go to the 30-year fixed. All right, so here's what has happened over the last year. Okay, so rates went from here, 8% to where they are today at 6.2. What did the Fed do during this time? Did they cut rates? They didn't cut rates. So how did rates go from 8 to 6? Well, it's because it's the rumors behind the scenes. Okay, so everybody's been saying the Fed's going to cut. We've been watching, well, the Fed during this time has been increasing rates, but the inflation level's been going down and down and down and down. And now we know, okay, that inflation piece is accomplished. So now the Federal Reserve can start cutting rates. Okay, so hopefully that plays a role in your decision making. You don't have to wait till September 18th or November 7th or December 18th to wait for the Federal Reserve to cut rates. Just continue to watch my videos daily, and I'm going to show you as rates come down further and further and further. Don't be surprised if on the day the Federal Reserve comes out and cut rates might go up just a little bit, and that blows people away. So that's basically how it works. We're basically, the markets are trading or working on the rumors of all this information, and then when the data is presented to us, as long as it's not skewed one way or another really bad, and then the markets just absorb that data. So hopefully you understand that part of it now. So let's get over to see what the broader indices are doing. Well, let's first go to see what the bond market's doing. Basically flat right now. So if you don't know what this is, how we follow mortgage rates on this channel is we don't watch the 10-year Treasury. We don't watch what the federal funds rate's doing. We watch an MBS. What is an MBS? Well, it's a mortgage bond that trades on Wall Street. You might even have this in your portfolio. So what happens is the yield on this thing is the biggest component of your mortgage rate. Okay, so what you're seeing here is what's going on with the price. I'm going to reiterate. The price of the bond, right up there, there's the price of the bond. Here's how bonds work. It's kind of a yin-yang. When the price of the bond goes down, the yield or the rates go up. Okay, it's an inverse, what they call an inverse relationship. So when this is down, rates are up. When this is up, rates are down. So we love when this thing's going up. So let's go over to just a 1 month thing. It's going up a little bit. Let's go to a 3 month. Ooh, it's even going up more. Let's go to a 1 year. You can see how we started way down here and we ended up way up there. So that's where we've been from the 8% rate all the way down to the 6.2% rate. And again, the Fed never cut rates. So how did we go from here to here? We're trading on the rumors. And then when the Federal Reserve does come out and tell us what they're going to do, then it just balances out. So hopefully that makes sense to you. What's the broader indices doing right now? We have the Dow Jones once again up 200 points, the S&P 500 up 25, the NASDAQ up 0.5% to 78, the Russell 2000 up 32, VIX right over my head is going down. That means that's good news for the markets. This is the anxiety level. We don't want the markets anxious because it's huge volatility. Let's go to the cryptocurrency markets, see what they're doing right now. They're down there. They're basically flat at 58,000. Oil's probably up a little bit. Yep, it's up 0.85, so we're still under that $70 level. So right now, I'm loving the markets. So I do have an idea for you guys for today, but one last thing. Dow Jones gains with jumbo rate cuts back on the table. And we saw that all of a sudden, like I said, these market numbers changed. Okay, on Wednesday, the cuts on the November cut, there was a 60% probability that they would cut down to the 450. The 400 to 450 to 475 range. Now it's 92%. So not really sure what's going on there. I'm not expecting huge price cuts from the Federal Reserve going forward unless just the data says. I keep thinking they're going to go 25, 25, 25 and just be meticulous to that until they get to a point where they just have a settlement there. So that's what we're seeing right through here. I do want to show you guys one stock that, is in my radar. Well, it's in my portfolio, but it's in my radar once again, Philip Morris. So guys, like I said in the past, don't trade on what I'm buying or what I'm not buying or what I'm telling you guys. I'm doing this just to let you guys know what I'm doing behind the scenes and why behind it. Okay, Philip Morris is, you might not really agree with what they sell, but their stock is really, really good. They have a great yield. You can see that down through here. Let's find that right through here. Sorry, guys, I'm a little bit frantic this morning for some reason. Let's go down through here. So what we see here is the yield on this thing. You can see it right above my head, right through here. The yield is 4.33. So think of you putting money in a bank account and you're getting a 4.3% interest rate on your money. Still probably better than your bank. Well, let's go to the stock price. Let's look at what the stock price has done year to date. So year to date, this stock is up 33%. Let's go 1 year. It is up 32%. Let's go 5 years. It is up 67%. Let's go back to who knows when, 2009. It's up 150%. So you're getting a great yield in a stock that's appreciating very, very well. So check out Philip Morris. If you don't mind being in the tobacco industry or business, it might be a good stock for you to look into and put into your portfolio. So that's my report for today. You guys might ask, Dan, who are you? What do you do? I'm a mortgage advisor, folks. All I do, I've done it for 35 years. I've helped people buy homes and or refinance them. So if you go to the rate update, you can find out about me and my team. The one thing I want to ask you to do is when you're there, if you're looking to buy your first house, stop what you're doing and click the Grant Finder loan right there. Nobody's doing it. You got to find to see if there's any free money to help you with your down payments, closing costs, maybe paying that realtor now that you have to. So check out that. But if you want to put in your application, just hit the Apply Now tab, or you can scroll all the way down to the bottom, right through here, and you can give us a call at 844-775-5626, or you can email me, and yes, it's me directly, at dan@therateupdate.com. Sorry, guys, we have a lot of swishing going on today with my green screen, so I'll try to get that fixed. But that's it for now. I'll be back at the closing bell, let you guys know how this whole mess ended up for the day. Thanks so much for watching. See you later. Bye-bye.